When it comes to investing your money, there are a lot of different opinions on the best way to do it. Some people advocate maxing out your 401k as soon as you have some extra cash, while others say you should hold off until you've paid off all your student loans. So, what is the right order for investing your money? What do you invest in first? Hi, if you're new here, nice to see you. Welcome to Master Wealth, where we learn to grow our wealth slow and steady. When it comes to investing our money, there is an endless list of choices to make. 401k, IRA, HSA, student loans, mortgage, etc. The list never ends, and we're constantly fearful of making the wrong choice. That is why in this video, we want to share with you what we personally believe is the most optimal order for investing your money. Yes, every situation is different, and there's no way we can cover all the different scenarios in this video. But we firmly believe there are some general guidelines that most people can follow to make sure they're putting their hard-earned money to work in the most optimized way possible. Emergency fund. Number 1 on our list is an emergency fund. Before you put a dime into the stock market or anything else, your first order of business should include building up a reasonable buffer of cash. Store it in a simple checking or savings account or a high-yield version of them. The exact amount will be different for everyone, and much depends on your personal risk tolerance. But we recommend at least 3 to 6 months. We know it's not an exciting activity with your money, but there is a good reason. Imagine an emergency fund like bowling guardrails. These bumpers essentially keep your bowling ball from falling into gutters. They keep you in the game, even though you might have launched the ball improperly or your ball started spinning in the wrong direction. Think of an emergency fund like these bowling bumpers. Life will always throw you curveballs, and you need to be ready for them at all times. For me, a good chunk of my curveballs are most often related to my house. It might have to do with the fact that my house was built close to 100 years ago, but things are breaking all of the time. At one point, the heating radiators in my home were broken during the winter months, and at the same time, the pipes in my home were clogged so we couldn't flush. And after reaching out to the various handymen, they told me it would cost me close to $3,000 to fix a problem. Now, if I was in a more precarious financial situation and didn't have cash in my bank account, $3,000 could have easily kicked me off the game. According to a Bankrate survey, only 39% of respondents said they would be able to cover an unexpected $1,000 expense from their savings. Most often, people don't have a choice but to use credit cards to cover the shortfall, and it sends them into a deeper financial hole. In our journey to pay down debt, investing, or financial independence, there will always be curveballs. But enough cash in our emergency fund will ensure that we don't get derailed and help us stay on track towards our financial goals. 401k employer match. Number 2 on our list is a 401k employer match. If you work for an employer that offers matching 401k contributions, this should be your first and main priority. Before you do anything else, take full advantage of your employer's matching contributions. Why? Because a 401k match provides an instant guaranteed 100% return on your investment. For example, let's say that your employer matches 100% of your contributions up to 4% of your income. If you make $100,000 a year, when you contribute $4,000 into your 401k, your employer matches your dollar for dollar, another $4,000. You're essentially making 100% return on your investment instantly. There's not an investment in the world that offers risk-free returns like that. The stock market doesn't, a rental property doesn't, and even a lucky streak in Las Vegas can't compete. If you aren't sure if your company's 401k employer match policy, ask your HR department or your benefits manager if they have an employer match and how it works. And take full advantage of your employer matching contributions. A quick note: if you don't plan on staying at your company for too long, make sure to ask about the vesting schedule. The vesting schedule will tell you how long you have to stay at the company in order to keep the employer's matching contributions. The most common length of time that an employee waits to be 100% invested in the company match is around 3 years. Consider this when you're thinking about moving jobs. You want to be aware of how much money you're leaving on the table by accepting a new position. High interest debt. Number 3 on our list is to get rid of high interest debt. We won't categorize high interest debt as anything more than 5%. For most people, this would include things like credit card or student loans. If you have credit card debt that you've been carrying month to month, this is where you want to start with your debt reduction plan. There is no easy way to knock down high interest debt, except to just do it. List out all your high interest debts and create a plan for getting rid of them. You can use the debt snowball method or the avalanche method, whichever one best motivates you. Once high interest debt is knocked out, you'll be amazed at how much income you have available to optimize the rest of your finances. Roth IRA. Number 4 on our list is to max out your Roth IRA. In my personal opinion, the Roth IRA is one of the most tax-efficient accounts available to investors. In a nutshell, with a Roth IRA, contributions are made on an after-tax basis, but any growth is tax-free. Of course, there are conditions, such as needing to leave the money in your Roth IRA account for at least 5 years, and you have reached the age of 59 and a half. However, what is amazing about the money in the Roth IRA is that you will never need to pay taxes on it, ever. We don't know what the tax landscape will look like in the future. A new politician might decide that he or she needs to raise taxes to fund big government projects. When you contribute to a Roth IRA, you reduce the unknown tax-related risks in the future. There are some eligibility considerations to a Roth IRA. In order to contribute directly to a Roth IRA, you or your spouse must have earned income, but not too much. In 2024, if you're married filing jointly, the combined income exceeds $240,000. You're ineligible to make direct Roth IRA contributions. But if your income is too high to contribute directly to a Roth IRA, consider the backdoor Roth IRA strategy. We have a whole video here that walks you through step by step. In 2024, the contribution limit for anybody under the age of 50 is $7,000. If you're age 50 or older, the contribution limit is $8,000. HSA. Number 5 on our list is to take advantage of a health savings account, also known as HSA. Now, this may not be for everyone since, in order to contribute to an HSA, you need to be eligible to do so. You must be covered under a qualified high-deductible health plan, HDHP, before you can contribute to an HSA. However, if you do qualify, this is a great way to save money for future health-related expenses. HSAs offer what's known as triple tax benefit. Your contributions are tax-deductible. Your money grows tax-deferred while in the HSA, and you can withdraw money from your HSA tax-free as long as it's used to pay for qualified medical expenses. If you'd like to learn more, we have a whole video here where we delve deeper. If your qualified high-deductible health plan is for yourself only, you can contribute up to $3,815 in 2023. If your qualified high-deductible health plan is a family health insurance plan, you can contribute up to $7,715 in 2023. If you're age 55 or older, you can contribute an additional $1,000. 529 Education Savings Plan. Number 6 on our list is the 529 Education Savings Plan. If you have children and if you're looking to save money for your children's future college, a 529 Education Savings Plan offers a great tax-efficient way to do it. A 529 Education Savings Plan is basically like a Roth IRA but for education expenses. Contributions are made on an after-tax basis, But growth is not subject to federal tax and oftentimes state tax as well when used for qualified education expenses. 529 plans do not have annual contribution limits. However, contributions to 529 plans are considered completed gifts for federal tax purposes, and in 2023, up to $17,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Max 401k. Alright, number 7 on our list brings us back to 401k. But this time, not just for the match, but to completely max it out. Just because we've taken full advantage of your employer match doesn't mean we can contribute more money to our 401k. This is one of the most effective ways to lower our taxable income and put more money into the market. I have personally saved thousands of dollars per year on my taxes just for maxing out my 401k. In 2024, the contribution limit for anybody under the age of 50 is $23,000. If you're age 50 or older, the contribution limit is $30,500. Taxable account. Number 8 on our list is now the taxable account. Once you've maxed out all your tax advantage options when it comes to your investment, you can start investing additional money into a regular taxable investment account. We've talked to a lot of people who are excited to jump into the market, and oftentimes, they're opening up taxable brokerage accounts way before they've maxed out all their tax advantage accounts. But this should be your last priority since you don't get any tax advantage when you use taxable accounts. The tax drag from using taxable accounts instead of tax advantage accounts, like a 401k, can be significant, especially when compounding over decades. Tax advantages like tax deductions allow more of your money to get to work for you sooner in the market and therefore greater growth in the long run. Why pay more in taxes than you need to? And make sure you're also following the index fund or ETF strategy when it comes to your taxable accounts. Individual stocks and mutual fund picking is a loser's game, and you're a winner. Lower interest debt. Number 9 on our list is where you can tackle lower interest debt. And I would say lower interest debt are debts with interest rates lower than 5%. Most often, this would include low-rate student loans and most car loans. Note, I do not include most mortgages, even though from a financial perspective, this step may not be hurting you as much. I would still recommend getting rid of it if you have the means to do so. Debt is quite an interesting concept. It is touted by some as a way to achieve the American dream. Others say it's a devil and should be avoided at all costs. My personal perception is this: never let our guard down around debt because it has a way of easily warping our perception about money. When we accept debt as a normal way of life, it can quickly cascade into a borderline dangerous mindset of justification. We can start to fund an elevated lifestyle with a low-interest debt, buying cars we don't need, getting student loans for a degree that will advance our career. If at all possible, get rid of as much debt from our lives. You're not only taking care of your financial well-being, but your mental, emotional well-being as well. Pay off mortgage. Number 10 on our list is, I personally believe, optional but a valid way to deploy your money if you choose to do so, and that is to pay off your mortgage. If you purchased a home in the last few years, you hopefully benefited from a low interest rate environment, and you have at least a decade before your loan matures. With a 15 to 30-year time frame, your chances are the stock market outperforming your 2 to 4% mortgage is very high. So I would say it makes sense to invest your extra cash into index funds rather than the mortgage. However, if you're getting to the end of your mortgage and you'd like to be completely debt-free, this is a great option. I mean, is there anything better than living in a mortgage-free home? That's it, guys. Thank you for watching. Remember, financial freedom starts with an adaptable mindset. See you in the next video. Cheers!